Hi, my name is Jasmine Cruel,
And my name is Mercedes Mahakit Kirichai.
and today we will be presenting Chapter 14, Professional Financial Planning. In this chapter, it discusses the process of getting a financial plan and the focus of life insurance at each stage of life. The objectives of this chapter are five-step financial planning process, early, middle, and later adult life years, liquidating retirement, business users of life insurance, and the taxation of life insurance.
And before getting into our presentation, we would like to share a short video that sums up many of the topics we'll be discussing throughout this presentation.
Okay, the first step that we will be discussing is the five-step financial planning process. Professionals must establish a relationship with clients and reveal important information such as prices before preparing to create a financial plan. When preparing a financial plan, there are five steps professionals must follow to achieve an effective financial plan. The first step is to motivate and educate clients. The second step is collecting the client's information. The third step is developing goals. The fourth step is implementing those plans. And the fifth step is reviewing and updating those plans. There are different types of financial planning professionals. Here are a few examples. There are the chartered financial consultants, certified financial planners, and personal financial specialists. Step one is to motivate and educate clients. Clients can be hesitant to create a financial plan. So professionals must motivate and educate clients on the benefits and advantages of having a financial plan. Professionals can give examples of how better off the client will be with a financial plan, give testimonials from clients with plans, or they could teach their clients the basics of financial planning. Step two will be collecting the client's information. The professional must collect the client's information to craft a financial plan specifically for them. There are a few statements that the financial professional can collect. The first one will be the net worth statements, cash flow statement, or the cash budget. A cash budget is to control spending and increase savings. The second form of information they can get is the adjusted cost basis. Adjusted cost basis is the net cash outflow for purchased property. The third information that they could collect is the attitude towards the financial risk from the client. This is important because the client's attitude could change over time with a high-risk plan. The third step is to develop goals. The client must differentiate their goals and categorize them as short, intermediate, and long-term. Usually, clients start out focusing on asset allocation plans. An asset allocation plan is when a client divvies up their assets into percentages and is either held in a low-risk investment, such as money market funds or certificate of deposits, or in a high-risk investment, such as mutual funds. This step will determine the client's attitude towards the process because the market fluctuations will shift their actual proportions. Step four is implementing the plans. In this step, the client and professional will start putting the plans in motion. This includes purchasing more life insurance, creating a mutual fund, and creating needed legal documents such as a will. The fifth step is to review and update the financial plan. Life can be predictable, so there must be room for changes and adjustments in a client's financial plan. There are many situations where the client must have to make adjustments, such as receiving a raise at work, having children, getting a divorce, or inheriting wealth. Therefore, the client and professional must meet frequently to review the financial plan. We will also be discussing early adult life years. Calculating life insurance in early adult years focuses on saving money in premature death. The professional will gather needs from the young adult and calculate needs-based purchases. Purchased life insurance is an amount equal to the assets required to complete a financial plan. The young adult can choose between different life insurance policies. The first one is permanent policies, which has a saving feature and it is active until death. The second kind is term insurance. This is only for a set number of years without a savings feature. The resources important to consider are either temporary or permanent to help understand what is important in a life insurance plan. The resources that are permanent are a burial fund, which is funeral and final illness expenses, and an estate preservation fund, which supports the costs of an estate for the heirs or of a property. The temporary resources is an education fund, which funds college education, an income fund, which funds spouse and children after a wage earner's death, and lastly, a debt retirement fund. This is after the death of a person who has accumulated debt is left to a spouse. It is, however, it is debt that is paid off, which means it does not exist after death. After death, funds are calculated, and the total assets available are calculated to meet these needs. Life insurance purchased equals financial needs minus available assets. The middle adult years focus on life insurance and annuity funds to fund retirement period. Middle adult years are from the ages 40 to 60. Planning for retirement must include estimating the length of their life and health status, forecasting the amount of sources of pre-retirement and post-retirement income, predicting the amount and type of retirement expenses, estimating the age of retirement, gauging the impact of inflation on pre-retirement and post-retirement finances, and anticipating the possibility of dependent children, parents, or both.
And now we'll talk more about the later adult years. Estate planning. Estate planning is the process of transferring wealth from one generation to another. The end goal of estate planning is to produce a logical and economic transfer of assets that is consistent with the owner's desires as well as lifetime needs. All estate plans require a will, which is a legal document in which a person directs the disposal of their assets at death. A federal estate tax is a tax on the transfer of the estate from a deceased person. The government also taxes lifetime gifts because often people give away their assets in order to reduce their federal estate taxes, and this is called federal gift tax. Together, they are referred to as a uniform transfer tax. The unlimited marital deduction allows the first spouse to die to give all property to the spouse. The charitable deduction subtracts from the taxable estate the value of the property that is transferred by an approved arrangement or a will to organize it to charities, churches, and universities. Oftentimes, life insurance is paid into a trust, which is a legal arrangement that allows a trustee to manage property for the benefit of someone else referred to as their beneficiary. Another policy is survivor life insurance, which is when two people live under one contract. The beneficiary is paid only after the second death. The next thing we'll be talking about is liquidating retirement savings. Oftentimes, professional financial planners encounter a challenging problem, which is when they're advising their clients on how to liquidate savings that they have accumulated for their retirement. Here are some recommendations in order to save for retirement. Qualified pension plans, individual retirement accounts, 401k, 401(b) plans. The government provides tax incentives that defer taxes to encourage people to save for retirement. However, the government highly discourages pre-retirement withdrawal of tax advantage retirement savings by applying a 10% early withdrawal penalty prior to age 59 and a half. How business utilizes life insurance. There are three main reasons why businesses utilize life insurance. First is the benefits for their employees. They also want to protect their firm from financial problems caused by a loss of a key person. And lastly, to aid transferring business ownership in all different aspects of a business. That could be a corporation or partnership. Typically, they both need to purchase life insurance to properly transfer ownership once a proprietor is deceased. In a split dollar life insurance plan, both employee and employer pay a part of the premium. And lastly, a buy and sell agreement is a legal agreement between a buyer and a seller of the purchase, and they can be arranged in a cross-purchase plan or entity plan. Now we'll talk more about the taxation of life insurance. I would like to add that this is a process that is not easy, and it does consist of many instances. Death proceeds, the premiums pay for the individually purchased life insurance, and they are not deductible from a person's federal income tax. The beneficiary receives the proceeds of a life insurance policy, but no federal income tax applies to this amount. And also, a transfer for value occurs when a life insurance contract is sold or transferred, and the value is the difference between the death benefit paid and the purchaser's cost is taxable income. The living benefits, dividends, savings, and accelerated death benefits. If the policy is participating, the contract entities the owner to share of the profits, often referred to as a dividend. If a life insurance policy has a savings value, the owner can legally withdraw this value. And lastly, if the insured is terminally ill, many policies actually give the owner the right to receive a lump sum settlement based on the policy's death benefit. And lastly, we discussed many aspects regarding professional financial planning. The professional financial planning consists of a 5-step process, which is to motivate people, collect data, create goals, implement goals, and also to review and regularly update plans. There are many different focuses on the different planning process throughout the cycle. The chapter breaks it down as the early years, middle adult years, and later adult years. There are many reasons why individuals as well as businesses purchase life insurance. Individuals purchase life insurance to provide protection for uncertainties in life, while businesses purchase life insurance as a safety measure if they were to lose a key person, to provide employee benefits, and also to transfer ownership rights from the current owner to future owners. And the taxation of life insurance does consist of many instances and is not an easy process. And thank you guys for watching our presentation.